when we're selling options, it is amazing as in the fact of like you get to decrease your downside risk. You get to collect more premium or more income, more of a return on your current stock, but it does require money.
Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Shaun Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach. And I'm here to help every teacher, whether you are a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck, to have a richer wallet, classroom, and life. The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional. I'm super excited to have Austin Bouley on the show today. Austin has been investing in stocks for 8 years, and he's launched his first stock software in 2020, and he continues to invest, especially using options, and loves doing it, which means that he is the master of options trading, which is what we're going to be talking about today. Austin, welcome to the show.
Hey, thank you so much for having me. I'm so glad to be here.
Awesome. Well, let's dive right on in with what are options? How are they different from stocks or bonds or whatever else someone might think of when they think of investing in the market?
Yeah, for sure. So I think when everyone starts off in the market, they start off with stocks, which is a great first thing. I think everyone should hold stocks. But then after that, you start to get a bit more down the rabbit trail, which leads you to options. And so if you don't understand options well, you may think it's a super risky thing, but hopefully in this podcast, I can show you some ways and some strategies that kind of make it more simple to help you increase your returns and also protect your portfolio. But essentially what an option is I like to explain it as a way to make a bet on a stock. And so again, you can think about it about a lot of different ways, but you're essentially betting about what a stock will do. So if you think a stock will go up, you're going to bet that it goes up. If you think a stock will go down, you're going to bet that it goes down. And so again, you kind of make money and lose money that way. But there's also different ways to use options to hedge things where you can be right on like where the stock goes, but also massively reduce your risk. And I think we'll talk more about that in a second. But essentially, just to clarify, options give you the right to bet on what a stock will do.
So is an option more risky than just putting money into a stock, or is it less risky?
Yeah, that's a great question. So options inherently give you 100 times the leverage. So if you have one option contract, that is similar to owning 100 shares of that stock. So that means that if you were to normally just buy one stock and it goes up $5, you would make $5. But if you owned one option, it would go up by 500. And that seems awesome, but you also have the downside risk of if the stock drops by $5, well, instead of losing $5 with one share that you own, if you had one option contract, it's similar to 100 shares, so you would be losing $500. And so you do have to understand that options inherently give you more returns, but also more risk because it's 100 times the amount of shares that you would have for one contract.
All right. So I'm going to be honest, I am not super well versed in options. So this is partially just because I want to know more about it. So can we just like go through the mechanics of it? I mean, like I know there's things like calls and puts and strike price and expiration dates and all these different like mechanics of how an option works. Can you just break down like the process of an option and make sure you define those words along the way?
Yeah, for sure. So like I mentioned, the way that I like to explain options is you're betting on something. And so when you bet, you have a contract between two people. So this options contract is a contract. So it has certain terms, certain dates, certain numbers. And so that's what we're about to talk about. So when it comes to it, you can either have a call contract or a put contract. A call contract, which is essentially call options, make money as the stock goes up. You're betting that the stock will move higher. So if you were to buy a call option and the stock went up, that option would make money. And then we also have the inverse of that, which is the put contract or the put option. So if the stock goes down, your put contract would go up in value. So calls are betting that the stock will go up and puts are betting that the stock will go down. So that's essentially, you have two different types of contracts, either a call contract or a put contract. And when it goes into the specific terms of that contract, the two main ones are the strike price and the expiration date. The strike price is the price of the stock that you're betting on. So for instance, let's say I want to bet that the stock will go up to a certain price. So again, if I'm going up, that's going to be a call contract. So I'm going to do a call contract. And then my strike price is the price of the stock that I'm betting on. So let's say I think it'll go up to $500. So I would be picking a call contract with a strike price of $500. So your strike price is whatever price that you're betting on. And then every contract has something to where it ends. Like this contract becomes executable at a certain date. And so that date is known as the expiration date. And so again, the further out in time you go, the higher of a chance you have for your option contract to be valuable, because you have more time for the stock to potentially get to your level. And so that's kind of what you're looking at when you're buying options. You're buying it with the hope that it gets to that price. And so I hope that kind of makes sense, but you can also do the inverse. You know how when you buy stock, and that means that you make money when the stock goes up, but there's also a way to short sell stock, which means that you sell the stock first. And so if the stock goes down, you actually make money from it. Well, you can do that with options too. And so for instance, a call, you want it to go up to make money, but if you sell the call first, then you actually want the stock to go down to make money. So it does the inverse. And I'm bringing that up because selling options is what investors want to do. Buying options is what you see on Wall Street bets, hearing like YOLO your money type of deal, because you have the chance of it going up by $5, $10 and you make 100x that for the option if you just buy the option. But if you sell the option, you can sell the option against current stock that you own, and that is what gives you kind of this I should say reduces the risk on your investment accounts and also helps provide income. But I should just clarify here, did those basic terms make sense? Calls, puts, strikes, and expirations?
Yeah, I mean, call, you want it to go up, put, you want it to go down. Strike price is the price that you're betting on, and expiration date is when the contract ends.
Sweet.
Is that correct? All right.
Yeah.
So you are saying that you are not recommending necessarily people are going out and buying the options, but that they are selling the options, and that's kind of what you do?
Yes, for sure. So selling options. Yeah. So the whole thing of options were created as an insurance agent. So for instance, let's say you bought shares of SPY at $400. And you're afraid that the market's going to crash and come down against you. People would buy a put at a certain price where like, hey, if this strike price, if the stock gets below this price, then no matter where the stock is below this price, I want to close the stock at this price. And so options give you that ability. So let me just put some numbers to this. Let's say you buy SPY at $400 and you're like, okay,
tell us what SPY is, just so.
Yeah, so sorry, yeah. So SPY is the ETF for the S&P 500, which tracks the overall market. So if someone wants to invest in, let's say, the US economy as a whole, they would just buy a few shares of SPY, which tracks the biggest 500 companies in the stock market. And so
also known as SPY, correct?
Yeah, SPY.
Okay.
That's the ticker symbol. And so for SPY, that tracks the overall market. Let's just say that you buy in, I'm just making up these prices, at $400. So it's worth $400 a share. And let's say that you don't want that stock to go down past 350. What you can do is you can buy a put option at the strike price of 350. And that means that even if SPY goes below 350, let's say it goes down to 300, you at expiration date still have the ability to get rid of your shares at 350 instead of where it's currently trading at 300. So options were created for this reason, to protect that account, to give you the ability to close your shares or get rid of your shares at a price that is more favorable. However, you pay a premium for it, just like insurance, right? So this is giving you insurance. You get to limit your losses with your portfolio, but you're paying a premium to do so. And so, the example here where I just gave, where you bought it at 400 and it's now trading at 300, but you get to close it at 350, so you save a $50 loss per share. You would have paid a premium on that, maybe paid $100, $200 to be able to have that right. And so when you do that, that's what you're doing, is you are paying the premium to get that security. And now when you're selling options, you become the person, the insurance company, providing that security. So people pay you the premium and you give them the right to do that. And so when you sell options, you become the insurance company because you collect these premiums on an event that very unlikely happens, that it drops huge. And so again, you can do that and then collect money in the process because you're collecting the premium as income. And let's say a covered call strategy, which is, again, that's kind of the base that I want to get to for investors, is doing a covered call. And I say that because let's say you own 100 shares of stock, whether that be ExxonMobil, SPY, whatever stock company you want to own. If you want 100 shares of it, you can sell a call against those 100 shares that you have, right? Because an option is equivalent to 100 shares. So one option would be equal to 100 shares. So if you own 100 shares and you go, like, let's say the stock is trading at 400, you can sell a call at 450. And as long as the stock never gets to 450, you collect that premium and you don't have to get rid of your shares. So this is a covered call, and it's amazing because you're able to collect premium on shares that you're just owning, and you can go super far out. Like, let's say it's trading at 400 and you don't want any risk. You can go up to $500. Say if the stock gets to 500, which is virtually impossible, you still collect premium. And then you're able to use that money that you're receiving to offset the cost of the stock. And so again, you get a lower and lower cost basis. I feel like I went super in the weeds there. But did that kind of answer the question?
Yeah. So I realize that this is a complex thing that if you're not already in the stock market, if you haven't been trading in the stock market, or just buying in the stock market, it's not the place that you start necessarily. But if I understand correctly, just breaking it down for our listeners, if you want to be investing in the stock market and you want to increase your return, you're able to sell these options as basically an insurance policy to somebody else, that their returns won't get obliterated. And that's going to allow you to collect some income from that. But with the understanding that the risk is, if that event does occur, then you're covering that cost. So there is still that risk involved.
Correct. Yeah. And so those 100 shares that you own is essentially your collateral that you have to give them if something goes wrong. But the way that you can do it and structure it is, like, if it looks like you may have to pay out and you don't want to get rid of your shares, then you just simply get rid of that contract, and so that you no longer own it. Obviously, that comes at a price. That's something that you can do as well. But yeah, it's just like, at the end of the day, though, if you do get rid of your shares, like I said, the price above the market that you're doing, so let's say it's trading at 400 and the price is 450. Well, if it gets to 450, well, then you just made a $50 increase per share on your stock. So yes, you're getting rid of your stock, but you made a good profit on it, plus the premium that you received. And then you can just buy back in. But yeah, there's always risk to it, and I definitely wouldn't start off with options if you're getting new to, if you're new to investing.
Okay, so let's say that this concept of increasing your return on the stock market through options selling is interesting to one of our listeners. What's like a first step that someone should take if they're trying to feel their way into this?
Yeah, for sure. So obviously, I would learn more about options. Make sure you fully understand the difference between calls and puts and all the different mumbo jumbo, like strike price, expiration, how to read an options chain. Because when it comes to like stocks, they just show you like buy and sell. Those are like the only two buttons, because that's the only thing you do. But when you look to buy an option, there's so many of them, because there's so many terms, so many things that you can structure. And so you have to look at what's called an options chain, which shows you so much. So you need to get familiar with how to read that, what option you want, knowing what that means. And after you do that, I would just kind of like paper trade it. Most brokers allow that. If not, you can just use just a pen and paper to track, okay, if I would have gotten in this here, would it eventually hit my price 30 days later, things like that. And then start with one contract and then go to one contract, and you can slowly size up from there. But definitely I would do learning, paper trading, and then slowly size up starting from one contract.
So paper trading is where you pretend to do it, but you're not actually putting any money into it, correct?
Correct. Yeah. So most brokers would be like, hey, do you want to try it out without risking your own money? And they go, yeah. And so they're like, okay, here's $100,000 of fake money that you can trade however you want. And so if you risk it, if you lose it, it's not affecting your real portfolio.
Okay. Okay. So I feel like I want to make sure people are understanding this, because this is not a simple strategy, and it's not the least risky strategy. So you're talking about, you're betting on these things going up or down, which means you do need to know the company or the ticker symbol that you are betting on, right? This isn't a throw a dart at the board and be like, oh, I guess we're going with FQYR. I don't even know what that is. It's just like, you don't want to shoot something random and say, I'm going to bet you might as well just go to Vegas and have more fun doing that. Yeah. You do need to make sure you understand these things and are, reasonably aware of what's happening in the economy and the world. If that interests you, options can be great. If it does not interest you, it's not your thing, right? So make sure that's something that you are interested in learning about before you decide to dive into this. Do you use options as like the main driver of your portfolio, or is it just like a complement to your portfolio of stocks and bonds? How does that play together?
Yeah, so I actually am very split on what I would recommend like the average person do. I start off with like covered calls, because if you're just someone who's getting into the market, then obviously buying shares of stock, specifically an ETF that is well diversified, one of those being ticker symbol SPY is one of those. Just owning a lot of those shares is incredible and will set you ahead of the curve. It will average roughly 8% a year. And so that's a great returning asset. And then if you want to kind of stack leverage on top of that, then you would sell calls, and then you collect premium on the shares that you already own. And so with that, I have roughly 50% of my portfolio just in long-term assets like SPY, so that it's just invested in the overall market. And then 50% of my money is set aside to do specifically option selling, where basically I become the insurance company. I collect premiums, and then I just collect money that way. And I use that, and I use the premiums and the money collected from that to then funnel into long-term accounts that I can then build more stock portfolio that way. But I'm definitely taking some risk here on this side, but I definitely mitigated some. But yeah, I'm taking risk here to help fund a longer term stock portfolio.
I love that. Just pointing out that you're not putting everything, not betting all in black like you're talking about. It is a diversified portfolio. You don't want to assume too much risk, especially because this is probably the money you're going to use to retire on. Mm-hmm. So just making sure that you don't have everything in a 100x risk type of position, for sure. Well, that's more of the buying side, right? It's slightly less risky when you're selling, but still, being aware that the higher returns have a higher risk. So keeping some of the lower risk portfolio pieces is important. Mm-hmm. If I was going to, start talking to you and tell you I wanted to get into this, when would you tell me don't?
Yeah, so when we're selling options, it is amazing as in the fact of like, you get to decrease your downside risk. You get to collect more premium or more income, more of a return on your current stock, but it does require money. And so we get to a point where like, investing in stocks is amazing, but if you want to start using these very safe strategies, for instance, the covered call, you need to have at least 100 shares of that stock to do it. So you need to be able to build a safe portfolio, a good sized portfolio to be able to do it with. Now, it depends on what you're trading, right? Or investing in. If you're investing in SPY, that's like $500. So to get 100 of those shares, it's $50,000. If you're doing something like, I don't know, a cheaper stock, Nike is probably like $20, then you could get up to $2,000 and then sell cover calls on that. So at the bare minimum, you need a good size account, $5,000 plus before you start considering this. And also, like we mentioned before, options are risky. So you want to make sure that your risk is low. So I like to keep my risk on my options to be less than 2% of my account size. So like we mentioned here, if I'm risking $200 for this option, then I want to make sure that my account size is, rough math, $40,000, right? And so, or something similar. And so I just want to make sure that I'm balancing risk correctly. And so the first thing you would want to check is, hey, do you understand that this is risky? Do you have that understanding? Second, do the account size that can handle it? And third, do you know that you need to go into this with a strategy that you need to follow, and it's not like get rich quick, put all your money on black type of deal. So if you have any of those criteria that you're not matching, I'd be like, hey, this might not be for you.
All right. I was going to ask you the opposite side of that question, but I wanted to take a little detour here. Many teachers have a good size portfolio in like a retirement account.
Mm-hmm.
Are there any options for options trading in like whether it's an IRA, a 403b, and a 401k type of thing, or is this strictly like you have to have a taxable brokerage account to do this?
Yeah, that's a great question. It depends on the strategy that you're doing. If you're just selling an options contract outright with nothing to cover it, for instance, the covered call has 100 shares that's backing the option that you sold. If you're just selling an option by itself, then the broker doesn't like that. And so they make sure that you have a lot of money or a lot of cash that set aside to be able to do that. However, if you're doing a very simple strategy like a covered call where you already own 100 shares and you're just selling a call against those shares, so those shares are collateral, then they're completely fine with it because you have all the money, you're basically following best practices, and if anything goes wrong, well, you have the 100 shares to back anything that goes wrong. And so they allow it in all retirement accounts, any self-managed for 403bs or pension funds that allow you to self-manage. You can do it all through there.
Okay, but it needs to be a self-managed version because there are those more directed versions that you don't have control over. So
yeah, so if you don't have control over it, again, you're gonna have to speak to the advisor that you're working with. But there are, because a covered call is just a very safe, very great strategy for most people, they have covered call ETFs that basically this fund sells covered calls against popular assets like SPY or NASDAQ or something like that. So the tech market or the overall market, for example. And then they'll, instead of you getting the premium, they return the premium to you as a dividend. And so if you do have a directed one where someone's doing it for you, you can speak to them about maybe adding 10 to 15% of your long-term investment being in a covered call ETF, because I just looked it up this morning, and QYLD is a covered call ETF. And again, your returns roughly mimic the stock market, but you also get a 9.5% dividend every month because of that premium income that's being returned to you as a dividend. So that's one way to do it if you have someone who's managing your account.
Okay, so I really need to understand something here. We have these covered calls, you say they're really safe. Why would somebody on the other side be wanting to go into this if it's really safe for the person that's selling them to you?
Yeah, so that's a great question. So obviously you're selling it, and depending on how far away you're selling it, the safer it gets. But the reason that somebody wants to buy that is because they want to have the ability to, like, for instance, get rid of their shares at a certain price. And so, for instance, let's say that you're selling it at $450 as your strike price, which means that if the stock gets to 450, then you have to pay out. So basically what this person is saying is they're buying that call option from you because they want the ability to buy that at 450 in case it hits 500, right? So it's for people who think that the stock will dramatically increase, let's say from 400 to 500, and they want to have that right to, instead of buying it at 500, get it at 450. So that's where your 100 shares goes to them at 450. So they get them at a price of 450, and then they also make that difference from 450 to 500. So they're capitalizing on the upside, and then you're betting that the upside isn't as huge. So that's kind of where the pros and cons are, which is where I know you were going to ask me about this later of like how like when is this riskier. Is covered calls work great, except for very strong bullish markets when we're making like 10, like in like a matter of a week going 5 to 10% up. Covered calls work best in flatter markets, slower uptrending markets, and down markets. Obviously, if the market is going up dramatically, then you'll be paying out a lot instead of receiving premiums.
Okay, so the riskier time to do this is during a bull market. Any other times or things you need to be aware of with the risk of doing options?
I mean, it depends on the option strategy that you do. Everyone is structured differently. Some make money when the market goes up versus down. Covered calls, though, which again is the easiest one because you're selling a call on stock you already own. When we're talking about that strategy, super strong bull markets is something that you want to stay away from. But outside of that, it's just the risk of the 100 shares being called away, being taken from you. But again, it's taken at that higher price, so you make profit either way.
Okay, so there's so many strategies that we don't have time to talk about all of them, and each of them have their own risk. So make sure you do that. Once again, that education is important before you just start saying, "Oh, it's an option." It's all the same. No, it's not, right? So
yeah,
I'm just talking about covered calls right now because that's pretty basic, pretty simple option. And that's one that you need to look out for, those particularly strong bull markets. Right now we're in August of 2024, and we're in a market. If it's not going up dramatically, it's not going down dramatically. So this could still be a good strategy at this point.
Mm-hmm.
All right. If someone wants to do this, speaking of education, what resources or tools do you recommend for someone looking to get started?
Yeah, for sure. So, I mean, obviously YouTube is a great place, but you're going to have to be careful of who's giving you info. I would say a great platform, they're called Tasty Live. They're an options education company. They don't sell courses because it's just like the educational arm of their broker. So they're a broker that provides education, but it's very good. So they have so many different options training and series. And so if you want to learn more about options, or let's say the covered call strategy, or maybe you want to explore others, they have a dedicated in-depth series to every option strategy. So Tasty Live is their name, tastylive.com. And then the broker is Tasty Trade. But again, Tasty Live has all that information. Also, again, once you kind of understand options, there's other things you can do. For instance, there's options automation software. And so, for instance, if you're busy, but you know that, hey, I like the cover call strategy, that's something that I want to do on like a weekly basis, then you can set up these automation softwares that will just sell a cover call every week, using best practices and sticking to certain win rates that you state. And then you can do that as well, because I know teachers sometimes are very busy. So that's definitely an option to help do that.
Do you have an options automation software you recommend?
So I'm going to be a bit biased here. I created what's called the Options Auto Trader. And so that allows you to automate option selling. And so most of the options automation software out there only allows you to do certain strategies. But my software allows all of the strategies. For instance, like a covered call, my software would be the only strategy that would allow a covered call strategy. And so again, you can use that. It's called the Options Auto Trader.
And where do you get that if you are interested?
Yeah, just www.optionsautotrader.com.
All right, awesome. All right, so wrapping up now, just got a few more questions for you. Teachers and educators, specifically, if we're trying to get into this, how would you recommend they fit this into their overall strategy for their finances? The things that are interesting about teachers is that we have a pension for the most part. We have a 403b, but those are often high fee providers because 403bs are not regulated well.
Mm-hmm.
And just being the nature of our job, we do not tend to have a lot of excess cash. What are your thoughts on how a teacher could incorporate this into their retirement portfolio?
Yeah, for sure. So I mean, I would think the easiest way, if you just want to get into it with very little money, would be going after a covered call ETF, because there's nothing you have to manage. You don't have to worry about picking the right options or anything like that. You get exposure to an asset that is the overall market, so it's very diversified by nature, and it's a very cheap ETF. QYLD is just one example. There's plenty of them though for a covered call ETF, but QYLD is only $17. So one thing you can do is just slowly, like even if you just do one QYLD share a week, or maybe even one a month, and just slowly build that up over time. Not only are you building a great asset because it's invested in the overall market, so it's very safe and it'll grow over time, but you're also building a great dividend machine, because again, you get a great dividend from that as well. And so the easiest way would be just to slowly add your investment, whether you're doing it through your own broker because you're limited with your 403b or pension. Just do it in your own broker. It's only $17 for that asset. Or if you can manage to talk to someone who's directing your 403b, if it's not self-directed, is to see if they'll be open to exploring a covered call ETF for your position. Again, I would say stick to no more than 20% of your portfolio being in that. Not because it's not safe, but because you are capped to the upside. Remember, I was mentioning like those shares do get called away. So during strong bull markets, QYLD will still go up, but you won't see as much upside. And so, yep, just having a blend of just the overall market and some covered calls, whether you're doing that yourself or you're doing it through an ETF, is kind of the best way. And so that would be the easiest way. Again, if you have a self-directed 403b or pension, which means you can kind of control, which I know is rare, but if you do have that case, then you can sell cover calls yourself on it. But if not, I would say those are kind of your options. And it really starts off with understanding that we're looking at compound growth here. And so you don't need to put like $50,000 in it and then like right now, you're slowly building. It's like the same way if you buy one share at a time, and you just do that. You continuously buy one share every week of a stock. And then once you get to 100 and you want to increase your returns, you can sell covered calls on it. It's just slowly building that account, and then just keeping this in mind for when you want to kind of take advantage of the account that you've slowly built up.
Yeah, that's awesome. And we just mentioned a whole bunch of advice in these last two questions of places you can go to get some more information. And if you want to access any of those, I'll have links to them on our show notes. You can go to teachermoneyshow.com/podcast to find the show notes for any show that we have there. So you can go there for those links, so you don't have to go looking for these things yourself. Okay, Austin, got two more questions for you. The same questions I ask all of my guests. What is your number one tip for teachers to have a richer wallet, classroom, and life?
Yeah, for sure. So this one actually comes from my wife, and I say that because my wife is actually a U.S. history teacher in junior high. And so when she started learning about all this investing world, obviously from me, because I talk about it all the time, she was just very surprised, because she always thought like retirement was almost impossible for teachers. For herself, mainly, she was thinking that because she was thinking about, I need millions to be able to retire. And I was like, yes, you need a lot of money, but you don't need $1 million. You can get away with $300,000 to $500,000. And if you're doing it in a high dividend account, you're doing covered calls, things like that help increase your returns in a safer way, you can actually generate a good income from $300,000 to $500,000 account. And that seems like a lot, but it's definitely something that's more attainable than $1 million or $2 million for a teacher. And so just understanding that, like, hey, you got this, just slowly saving over time, you can definitely get there, and don't think you need $5 million to be able to retire. So just more like giving hope that, hey, this is possible, and you can do it.
Awesome. That's fantastic. I didn't know that your wife was a teacher, so that's cool. Even better connection. That's awesome.
Yeah.
All right. And if a teacher wants to get more information or just ask you a question, maybe, how could they get in contact with you?
Yeah, for sure. So I have a YouTube channel where I talk all about advanced option strategies. You can just look me up. It's called Austin Bouley on YouTube. Or if you want to email me because you have a personal question, it's just hello at optionsautotrader.com. That goes straight to me.
All right, awesome. Thank you so much, Austin. It was great having you on the show.
Of course, thank you so much for having me.
If you'd like to come on the podcast for coaching, to share an expert opinion, or just to talk about a topic you think is relevant, I'd love to talk to you. Just fill out the form at teachermoneyshow.com/guest. I look forward to talking with you.